We should begin with the question of December 2013. December 2013, question number 1B. December 2013, question number 1B. December 2013. December 2013. Okay, December 2013. Question 1B. So the question reads that Hansel Limited manufactures and sells a labor-intensive product branded mag. The standard variable production cost per unit of mag is as follows. We have direct materials, direct labor, variable overheads. Now, Hansel Limited has received orders from A Limited and B Limited to supply each company with 4 units of product mag. A Limited currently purchases this product in the market for shillings 25,800 per unit and is willing to pay the same price. But B Limited has allowed Hansel Limited to choose one of the following options. Option A, a price of 24,750 per unit. Option B, option 2, supply its idle labor force to Hansel Limited for 4 units of production, with Hansel Limited having to pay only shillings 1.5 per labor hour to B Limited's workers. In this case, Hansel Limited need not use its labor force for producing B Limited's requirement. Under this option, B Limited offers to buy the product at 21,000 per unit. The standard hourly rate is 6,400. Both Hansel Limited's and B Limited's labor forces have a running rate of 8%, applicable only to direct labor and not variable overhead. Both orders came before any work had started. Hansel Limited has the capacity to fulfill both orders. A Limited and B Limited shall not know of each other's offer. So you advise the management of Hansel Limited on the best course of action and ensure your work. So first of all, there is the issue of the running curve here. The issue of the running curve. So with the running curve, we need to say using running curve, total method, using running curve total method. Y is equals to AX raised power B plus 1. And B is the log of R. You divide by the log of 2. The log of R divided by the log of 2. So this will be the log of 0.8. You divide by the log of 2. Negative 0.322. So B plus 1 is minus 0.322 plus 1. 0.678. 0.678. Now, there are two possibilities here. There are two possibilities which are guided by the terms given by company B. Company A has no issue. So what will happen is that we will make the units for A together with the units for B. So by the end of the day, we will have made 8 units. Because A requires 4 and B also requires what? 4. So at the end of the day, we will have made 8 units. But there is a slight difference that is brought about by company B, whereby in option 2, they are saying it is them who will give us their workers. So our workers will not do the 8 units, but it is their workers. So there are 2 instances where our workers will first of all do the 8 units, and then the other one they do the 4 units. So, and both of them, we are told they have the same running effect. So, Y for 8 units, it will be, we are told the first unit is going to take how long? Is it mentioned? It is not, rather, maybe before we write that, we need to identify the other items. We need to identify A. Let's identify A, the time taken for the first. So the time that is taken for the first, the question has not mentioned directly, but it is mentioned indirectly in that we are already told up there that directly per cost is 12,000. You can see that. And then, according to information 3, we are told 1 hour is paid 464. So that tells you the time taken to make the first unit is how many hours? It is 2,000 hours. It's 2,000 hours. So X can either be 8 or 4. So Y for 8, it is going to be 2,000 times 8 raised power 0.678. Into 190.7. Okay. Higher. And these are hours. Then Y for 4. It is going to be 2000 times 4 raised power 0.678. $51.5 hours. So let's do now the income statement. Income statement. For option 1. Income statement for option 1. So the income statement will be drawn like this. We will start with revenue. This is A Limited. A Limited, according to information 2, A will buy the product and they are at 25,800 and they are willing to pay the same amount. So it is 25,800 multiplied by 4. 25,800 multiplied by 4. 103 is 1. Then B Limited, according to option 1, they are willing to pay 24,750. 24,750 times 4. 99,000. Then you less materials costs, direct material costs. Direct material costs okay, here's that done. Let's see your figures. Direct material cost is, you can see it is 15,000 per unit. But now we are combining that. We are combining them. It is 4 plus 4. So here it does not matter whether it is for A or for B. There is no difference. 120,000. Then kuja kwa direct labor. Direct labor costs. Now direct labor costs in option 1 ni sisi tunajifanyia kila kitu. So we already have the time for the 8 units. So unachukua hii 190.7 multiplied by these workers are being paid at 6 bob. The workers are paid 6 bob. 49,144.2. Haya, hiyo ingine ni variable overheads. Variable overhead costs. variable overhead cost, it is 3,000, and this one is not affected by the hours, so it is 4 times plus 4. That gives us what? 24,000. And I think that is all about the so based on that, give me the net profit. Give me the net profit. Hmm? 90, 55.8. 90, 55. So that is what will happen when you are with the first option. Now, when we come to the second option, option 2, there are some slight changes. Look here so that you make the changes. In option 2, these guys, they are saying they will give us their labor force, but now they will pay us what? 21,000 per unit. Then when it comes to material will remain, but for the labor force will have to change, and they will change like this. We will have 5119.5 multiplied by 6. That is for the first batch that belongs to us, to A. That will be done by our people. Then the second batch of 4 units will also take the same time. We are saying the same time because we were told they have the same running rate. But now, these guys who have come from there, we are told by option 2, we are only going to pay them 1.5. So times 1.5. That is the match that we are going to give. So work out, and then you will tell me the new profit. Everything else remains. Your hand is tight. Umepata 30 042.75. Those are online. Are you getting the same? Confirmed? Really don't be sure. Those who are online, are you confirming that figure? And then it's giving a different value. Maybe we could start from here. This one is what? Is 810? Huh? First of all, give me this 84,000. 84,000. Then this other one. 157.25. Yeah, I can see those who are right. They are giving me 4803. $4803.75. Now confirmed. Or they're saying for rebar it is 38,396. Actually, these are all is more than 30,000. So this is 5 and this is 6. Yeah. 38, 397, 397.75. This one, you see, instead of multiplying the two of them, you could also have said it is, you could also have said it is, you take these hours, 5119.5 multiplied by 6 plus 1.5. It's the same thing. Even this one on 48. Good. So if we are okay, the next question on the line is November 2018, question 1B. November 2018, question 1B. November 2018, question 1B. So the question says that ABC Limited is a firm that is engaged in the repair and maintenance of property, plant, and equipment. The firm has received an order from XYZ Limited to repair its property, plant, and equipment. The management accountant of ABC Limited has provided the following information. We are given direct materials, other materials, labor, depreciation and total costs, profit, and then suggested price. So we are given additional information, and then we are told to advise the management of ABC on the minimum price to quote on this contract. So when you are asked for such a response, the question is on what we call special pricing. Christine, welcome. So the question is on what we call special pricing decision. Special pricing decision is on special pricing decision. So we start with the direct materials as presented there. Direct materials. Now, direct materials, we have the 1,000 rods, each at 10 bob per rod, and they are described by information 1. So information 1 says the repair contract requires 400,000 welding rods, of which 100,000 rods are already in inventory. These types of rods are about to be phased out of the market, and hence, if they are not used, they will have to be discarded. If ABC Limited is awarded the contract, it will have to purchase an extra 300,000 welding rods of the new model at a cost of 12. So these rods, we have two types of them. There is what we call in stock, and there is what we call not in stock. Now, what is in stock is 100,000. What is in stock is 100,000, and what is not in stock is 300,000. So these ones which are in stock, we say the original purchase price is irrelevant. And the question says they will not need to be replaced. So if they will not need to be replaced, then you value them at 0 and you assign 0 there, because the original purchase price is irrelevant and you will not need to replace them. Next is that these ones which are not in stock, those ones you will have to buy, and we said you will buy at the current market price, which is now going at 3,600,000. It's 3,600,000. Then we go to other materials. Other materials. We go to other materials. Now, for the other materials, they are discussed by information 2. We are told other materials will have to be bought at the above price. So the other materials, those ones are not in stock. So if they are not in stock, you will have to buy at the price that is given there, which is 2 million. So those ones you will have to buy at a price of 2 million because they are not present. Twende kwa labor costs. Labor costs. Now, labor cost is discussed by information 3. That is the skilled one. So skilled workers will have to be hired at the cost. So skilled, what we will have to consider is the hiring costs. So the hiring cost is relevant. Sorry, it is relevant. The hiring cost is very, very much relevant. So we will have to consider it at 900,000. 900,000 is provided there. Then unskilled is discussed in information 4, where we are told ABC has 5 unskilled workers who are currently idle. The cost shown above is guaranteed salary payable to the 5 workers. So the unskilled is currently idle. We have excess capacity, and we say you have idle capacity, that amount is 0. It is irrelevant. Next is depreciation. And this depreciation, we are told that the depreciation given is for the general purpose machines, which are normally used to do other jobs, including the special one if allocated. So for the general purpose, now that it is general, or it is common, it is irrelevant. General cost is irrelevant. You cannot assign it to anyone, so that is irrelevant. Then for the specific is that the depreciation given is for machines which will be bought specifically for this contract. After the contract is complete, the machine will be scrapped without any alternative use. So the specific one is relevant. So we are going to have 200,000. We're going to have 200,000 there. 200,000. And then we are told ABC aims to earn a profit markup of 10% on cost of all work done. But when you are looking for the minimum price, you don't consider the profit. So you only now come here and get the relevant costs. The relevant costs. And this relevant cost is the minimum price. The relevant cost is the minimum price. 6.7 million. $6.7 million. Then you are told to describe why the method is not very popular. Obviously, one of the reasons is that no profit is made. No profit is made. That's one of the reasons why people do not prefer to do that. Because you can see we have ignored the profit. Number two is that the irrelevant costs, may still be incurred, and must be paid for, So if they have somehow they will be paid for. So how now do you pay for them? How do you pay for them? How do you pay for them? So I think that is okay. Kuna swali? So I think I'm okay with that, unless there is a concern. Okay. So the next question now is December 2014, question 5B. December 2014. I don't know whether that question was copied wrongly. December 2014, question 5B, new reconciliation, which we already have dealt with. I think it is the one we were using in class. You can't remember. CTO, we did in class. Yeah. So because it is coming in the topic of pricing. I don't know whether it was supposed to be. December 2014, question 2. Question 2, eh? Question 2. I think we can do that. Yeah, December 2014, question number 2. So in that question, we are told that B, 2B, see there? Best Limited manufactures a standard water heater. The data below relates to its production activities. We have the selling price, the variable cost of production, selling, and contribution. The company has a production capacity of 320,000 water heaters per month. The company has in stock 10,000 water heaters. Expected sales for the month of December 2014 at regular prices are 300,000 water heaters. The company has received a special order of 60,000 water heaters at a price of 1,700 per unit, and delivery must be made within 30 days. Assume that 40% of any sales loss during the month of December would be recovered in later months. Variable selling cost on the special order would be 200 per unit required. Advise the management on whether to accept the special order. The lowest price they could charge for the special order so as to be indifferent between the existing production and the special order. Suppose the special order is for 50,000 units per month at shillings 1,700 per unit for the entire year, and expected regular sales are 300,000 water heaters per month with no beginning inventory, and sales lost are irrecoverable. Advise the management on whether the offer should be accepted. So that question again is on a special pricing decision. The question is on special pricing decision. And we know that the special pricing, you only accept if the marginal cost is equal to or less than so we have said is the question of December 2014, question 2B. Question 2B. So we are going to divide it into two. We have details we have recoverable, and we have irrecoverable. So we have to get the units to know which ones are coverable and which ones are irrecoverable. So what we normally do in such a case, you need to get the stocks because the units are different. So we have to get the opening stock. Now the opening stock, according to information, information number 2, there is an opening stock of 10,000. 10,000. Then you add production. You add production. We are told that we have the capacity to do 320,000. 320,000. So if you add that, what you get is called available for sale. Available for sale. Now, what is available for sale is 330. You less the normal order. Not the normal order. We are going to give preference to the special order. You less special order. Special order. Now, special order is coming to take what? 60,000. Special order is coming to take 60,000. So what you get now is available for normal order. Available for normal order. We will be left with 200 what? 70. Then you less normal order. Normal order. And normal order is according to information 3 is 300,000. 300,000. So when you less that, what you get is lost normal orders. Lost normal orders because we'll have a deficit. We are going to have a shortage of what? 30. So 30,000 customers will miss. Then you get recovered. Lost orders. Recovered lost orders. Now, what is recovered? We are told we will be able to recover what? 40%. So it is 0.4 of 12,000. No. Of 30,000. That's the one that will give us 12. So 12,000, that one will come back. And when it comes back, then the net lost orders, they are 18,000. Before I move out of this, let's handle the one for irrecoverable. Irrecoverable is discussed in information 3 or requirement 3. That suppose the special order is for 50,000 per unit or per month, and the price is 17, and the regular sales are 300,000 with no beginning inventory, and sales lost are recoverable. So here, there is no beginning inventory, but we are able to produce 300 and what? And 20. So the available for sale is 320,000. 320,000. The special order, now we are told it is what? 50,000. So we will be left again with 200 what? 70. And the normal order or the regular order is still at what? 300. And now we are going to lose what? 30,000 again. But in this case, we are told what you lose, you cannot recover. So we recover 0 and we are left crying for 30,000. So the question is, do we accept the new order or reject the order? We accept or reject. The analysis will be like this. If special order is accepted, if special order is accepted. If special order is accepted, we are going to have revenue would be, this special order is 60,000 units. 60,000 units. And these fellows are saying they are willing to pay 1,700. $1 or $2 million. 1 or 2 million. 1 or 2 million. Then you less variable costs. You less the variable costs. And the variable cost will begin with production. So each of these 60,000, will incur a production cost of 1,200. The production cost, so 72 million. Then there is the selling. Each of these 60,000 will incur, according to information 6. The variable cost now will not be 300, but will be 200. Eh? Can you see that? Yeah, it will be 200. 12 million. Then there is something else that is called opportunity cost. And this opportunity cost is the lost contribution. I told you, as a good business person, you don't see your customers as human beings. You see them as money. So when a customer is running away, you should see money going away. So what will happen here, if you happen to accept the special order, then 18,000 customers will run away. When the 18,000 customers run away, you should see the profit that you should have gotten. And the profit is the old contribution margin, which is given up there as 900. It's given there as 900. Hmm? 16,200,000. 16,200,000, yes, certain. So I think with that, we get the net contribution. Net contribution. Net contribution 1.8 million. So what do you advise? Should we accept the offer or we should reject it? Good. We should accept the offer. We should accept because you can see it is giving us a net contribution which is positive. A net contribution which is positive. The next question is, the lowest price Besto could charge for the special order so as to be different between the existing production and the special order. Obviously, I've said the lowest price should be equal to the marginal cost or the relevant cost. So that one I'll just visit here. The lowest price. So the lowest price should be equal to marginal cost. Should be equal to marginal cost. And our marginal cost is this one, 72 million plus 12 million plus 16,200,000. Now all these you divide by the number of units. You divide by the number of units that are involved in that special order, which are 60,000. Yes. So you are getting 16, 7 as the minimum price they should quote. The next one is, suppose the special order is for 50,000 at 17, and we have 300, and the sales are recoverable. Advice. So that one, you will have to change the workings again. But now here, we will say it is 50,000. This one is also 50,000. 50,000. But and here, the lost contribution now it is going to be for what? For the 30,000. So revise those figures. Revise the figures. Then you will tell me whether we will accept or we will reject the offer. The loss of how much? 12 million. So the advice obviously then would be to reject. Agreed? Okay. So the next question is November 2016, question 5. November 2016, question 5. So the question reads that Sang Limited has two divisions, namely X and Y. Division X manufactures electrical components, which sells to Division Y and external customers. Division Y has designed a new product branded Year 2 and has requested Division X to supply the electrical component, which is required in the manufacture of the new product. Each unit of product Year 2 will require one electrical component. This component will no longer be sold by Division X to external customers. Division X has quoted a transfer price to Division Y of shillings 45 for each unit of the electrical component. It is the policy of Sang Limited to reward managers based on their individual divisions' return on capital employed. The details of the monthly production for each division are as follows. Division X the output is that the electrical component will be produced in batches of 1,000 units. The maximum capacity is 6,000 components per month. Variable cost is 15. Fixed cost is 50, and these are incurred specifically to manufacture the electrical component. Division Y, the output is that product here to be produced in batches of 1,000 units. The maximum customer demand is 6,000 units of product here per month. Variable cost is 9 per unit plus the cost of electrical component. Fixed costs is 75, and these are incurred specifically to manufacture product here. The relationship between monthly customer demand and selling price of product here is as follows. So we are given that. Now you are required that based on a transfer price of 45 per electrical component, advise the management of Sang Limited on the monthly profit that will be earned as a result of selling product here. And as a result of selling product here. So that question is on transfer pricing. So transfer pricing. And as I told you, we have a department called the supplier, we have the receiver, and we have the company. Tukasema, the transfer price is a revenue to the supplier, it's a variable cost to the receiver, and it has no effect on the company. Then we also say that the revenue of the last department is the revenue of the company. Not unless the first department also had something to do with the externals. So what the company will finally sell to the external market is guided by the last department. So what we need to do is to know the last department will prefer how many units, and that will guide us to know the profit that will be made by the company at large. So in doing that, we will have to prepare income statement for Division Y. Income statement for Division Y. And as you know, we always begin with units, which we call A. Then we have revenue, and revenue will be A times the price, which we shall call B. Then we have the variable costs, and the variable cost will be A times. First of all, they have to deal with the transfer, which is 45, and then their own cost. Their own cost is what? Is 9, eh? Something like that. Yes, Division Y is 9. And this one, you will call it C. Then from there, we will have fixed costs, which we will call D. And from there, we have net profit. Net profit is B minus C minus D. Okay, so we begin. The first one is 1,000. And the selling price at 1,000 is what? 120. So that would be 120,000. The variable cost then will be 54,000. And the fixed cost is 75,000. So give me the profits. Negative 9,000. The next one is 2,000 at a selling price of 110. Hmm? 220. 2,000 times 54 is 108. And the fixed cost is 75,000. That's 7,000. We go to the next one, 3,000. 3,000 is at 100. So that would be 300,000. Eh? And the variable cost will now be 162,000. The fixed cost is 75,000. Yeah? 63,000. Then we go to 4,000. At 4,000, the selling price is 90. 360,000. The variable cost is 2 what? 216,000. The fixed cost remains 75,000. 69,000. We go to 5,000. $400,000. The variable cost will be 270,000. The fixed remains at 75,000. 55,000. Then we are beginning 6,000. At is it 67? How many 60? 67. Okay. So multiply 2,000. And then we are beginning 324. The fixed cost 75,000. Breathe out. So the one that will maximize the profit is this one. This is 69. So that means they will prefer to make what? 4,000, eh? They will prefer to go for 4,000 units. Haya, sasa tulikuwa tumeulizwa, we get based on the price of 45, we advise the management on the monthly profits. So we need to know what will be the profit that will be earned by the company. What will be the profit that will be earned by the company? So the income statement, and now this one, we will not need to draw for all of them. We don't need to draw for all this. We just pick the 4,000 and see what happens with the 4,000. Because wakishajua how many units they are producing, they go for that. Yeah. So we are going to have details here. Then we have what will happen in division X. Then what will happen in division Y. And then we have the company here. So hii nilikwambia inapangwa namna hii. You bring the revenue, and the revenue you start with internal. Internal, X is selling to Y, and they are selling, we can have our figures now in thousands. We can have our figures in thousands. So they are going to sell 4 units at a price of 45. Because that is the transfer price. 180. Then we have the external. The only one who we are told about the external, although we are told even X is selling to the external, we are not told they are selling at what price to the external market. So we just ignore that. And got Y, which is going to sell 4,000 units to the external market. And we are told to the external market, they are selling at the price of what? 90. They're selling at the price of 90. So that gives us 300 and what? 60. And this one will find its way in the company. The 360 will find its way in the company. Then you say less variable costs. You less the variable costs. So the variable costs, first of all, we have the transfer. First of all, we have the transfer. Now the transfer will only affect division 1, which is 4 times 45 at 180. Then we have own production. Own production. So own production will first of all affect X, because X is going to produce 4, and the variable production cost of X per unit is 15. So that will be what? 60. Then when we come to Y, these 4 that they have received, it will spend 9 more. So you see these 9 and these 45, eh? Yeah. So that would be what? That is 6. So that is 6 plus 60, that gives us what? 96. Those two will find their way in the company. Then we now bring the fixed costs. We now bring the fixed costs. So the fixed costs in division X is 50. So that 50 is put here. And this other one is 75. So that would be 125. So that will give us net profits. Net profits. So get the net profit for each. Okay. This one is what? Huh? 70. This one? And this one? 39. We must always agree. When you add this to this, we must always agree. 139. Oh. We must always agree. The next thing now is the question is saying you advise on the maximum profit. Now the maximum profit is achieved when you transfer at marginal cost. So the fellow who said that question, I think there was a confusion because in Roman 3 he's now talking of the marginal profit, marginal cost. Can you see that? In part B is asking us of the maximum profit. That one is this one. The maximum profit. Or rather is it's not this one, because the maximum profit is achieved when you use marginal cost. So what is asking in Roman 2, it should have been the profit that the company will achieve once they adopt this format. But that one is already asked in Roman 1, because Roman 1, they had asked us to determine the profit, which now we have given to them. So in attempting to answer the next one, I'm saying you get maximum profit when you use marginal costs as the transfer price. When you use marginal costs. That is the point that so with that, we that we will come here and get marginal cost is what? Is 15. So we are going to revise this table. Going to revise this table so that we know how many units now we maximize profits. So maybe to show that they are separated, you can go to the one we already have worked to say transfer price is 45 shillings. The one that we have just finished, transfer price is 45 shillings. Now for the one that we are going to draw again, you say transfer price is 15, which is our marginal cost. Which is our marginal cost. So you get the net profits, then you advise me. And which one would be the best? So based on that, which one is coming out best? 5,000. 5,000 is coming out as the best. So then, if that is the case, then here is 5 times 15, that is 75. Then 5 times what? The price, the selling price there is what? 80. So they will get 400. This is 400. The transfer is 5 times 15, that is 75. Own will be 5 times 15, which is 75. Then 5 times 9, that will be 40. 5, so 45, that gives us 120. The fixed will be 50 and 75. Then we have 75, that is 125. So this must be a loss of what? 50. The other one? 205. So that the company now reports 150. So that is how it's supposed to be handled. So we call it a day at a juncture and hope to pick up from there tomorrow, which should be the last lesson.